Welcome to Finance Paradox. Today we're diving into the fascinating world of Forex trading. If you've ever wondered how global currencies interact and how traders make a profit from these interactions, you're in the right place. So let's get started. What is Forex? Forex, short for foreign exchange, is not a binary system as some might think, but involves the simultaneous buying and selling of two currencies, a major currency like the US dollar or euro, and a minor currency. You've already taken part in Forex if you've traveled abroad and exchanged your money for local currency. That's essentially what Forex traders do, but on a much larger and more complex scale. There are about 180 official currencies worldwide, and the combinations between them are endless. But in Forex, traders focus primarily on a select few. Electronic and other types of currencies, like cryptocurrencies, will be mentioned in a separate video in this series. Exchanging your money to get a foreign currency is what Forex traders do. The same thing you do as a single buyer is also done by big companies as they need to buy goods from other countries. To do so, they need local currency. In simple words, they constantly need to exchange their local currencies to obtain goods or services from other countries. The difference is that they need to exchange huge amounts. When big companies conduct business internationally, their vast transactions can influence the value of currencies. Basic economic principles tell us when demand rises, so too does the value. And so, as these transactions occur worldwide, the exchange rates between currencies constantly fluctuate. The Forex market operates 24 hours a day, 5 days a week, across 4 major trading sessions: Sydney, Tokyo, London, and New York. With around $6 trillion traded daily, it's the most liquid market in the world. But how does one profit from Forex trading? Imagine you're traveling from Canada to the US. You exchange 500 Canadian dollars at a rate of 0.75, receiving 375 USD in return. A week later, the exchange rate shifted to 0.76. Now, if you were to exchange the same amount, you'd get 380 USD. That difference, when scaled up, can represent significant profit or loss. And that, in a nutshell, is Forex. Today we've learned that Forex trading is about buying and selling currencies, and the exchange rates between these currencies fluctuate constantly due to global transactions. This provides opportunities for traders to make profits, as we've seen in our example. It's a complex field, but with knowledge and practice, it can be understood and even mastered. In our upcoming videos, we'll dive deeper into strategies for Forex trading, risk management, and much more. Make sure to hit the subscribe button and stay tuned for more insightful videos on finance.